on the numbers part, you brought up an interesting part about the pre-approvals.
Mm-hmm.
One of the things they look at is your length of employment
Mm-hmm.
or your employment.
Yeah.
So let's say you have a job that you've been there for 6 months, let's say to a year.
Mm-hmm.
Does the duration of your employment impact whether you're going to be able to get that mortgage or pre-approval?
So that's a good question. And honestly, like every situation is going to be slightly different.
Mm-hmm.
So there's no concrete yes or no, but it's more so fixated on the fact that is this income reliable? Is this income going to be something that we can count on you getting, right? So that's why more times than not, a lender, especially in the A space, they're going to be like, okay, are you a permanent employee or are you someone that, you know, is contract work? Or are you someone that's still on your probationary period? So that's why the main things you really want to look at is what is your guaranteed income, right? So for people who maybe are new to a job, and let's just say you got a job at like, let's just stay with Good Life, right? So
I used to work at Good Life.
You did too?
I was an FA at Good Life.
Okay.
Yes.
I was there too. I was just the greeter. I wasn't there for long. It was
Oh, you're a motivator?
Yeah, it was
Oh,
a
okay.
short-term fix. I wasn't there for a long period of time. But let's just say you're working part-time there, right?
Yeah.
And as part-time employees, I guess I won't kind of relate if you had part-time income, part-time employment at some point or another.
Mm-hmm.
You get your employment and you're like, okay, well, we'll give you 20 hours a week, but you end up working like 40 because you end up picking up shifts. You know, you can take everyone's shift if they're calling in sick, and you know, you might be making income as a full-time income earner because you're working 40 hours a week, but what are you guaranteed? So that all goes out the window if you don't have that 2-year history to show that, yes, this is how much hours I actually work. So if you don't have that 2-year history to prove that, they're going to say, okay, well, what are you guaranteed? So it's the 20 hours that we're really going to go off of. And that's really what the lender or the bank is going to factor in as your income. They're not going to look at you, you know, your pay stub saying that you got 40 hours last week. They're going to say, well, what are you guaranteed, which is the 20. So that's why you really have to make sure you do your pre-approval, because you might think you make X amount of money and you can handle X amount of, you know, debt or X amount of payment for every month for your mortgage. But what does the lender recognize as your income? And that's why it's really important to get that pre-approval, because what you think is your affordability and what you qualify for is much different than what the lender might qualify you for based on your situation, right?
So startup entrepreneurs are at a disadvantage, eh?
Yeah.
Yeah,
I'm
straight-
not going to sugarcoat it. I'm going to tell you
It's
straight.
gonna be tough.
As a self-employed individual, they want to see that 2-year history. And if not, there's the B lending space where they'll take your 6-month average and they'll annualize it, which is great. But to be in the B space, you've got to have that 20% down payment. So if you're going to come with things that are kind of wonky on your income, and you're going to be looking for certain adjustments to be made and exceptions to be made on your income, you got to come with the cash. And
So you better have like $100K liquid saved up.
Exactly. And that's why you can quickly see how living downtown or living in Toronto can be out of the question, because 20% of a 500K purchase is 100K. So if you don't have 100K and you don't have that 20% down payment, you can't be looking there. And that's why you see people like me, I'm like, I'm going to be in Brantford then, because I know I'm self-employed and I don't want to have to fork out 20% if I don't have to. So I'm going to go where my qualification fits me best, right? Because a B lender won't give you a mortgage for, like, I know we all talk about getting into a property for 5% down, because that means I don't have to end up saving 4 times that amount to have 20%. But B lenders don't do 5% down. They do 20% at a minimum. And if you're going to be doing 5%, you got to be an A lender space. So you got to make sure you have that 680 credit score. You got to make sure you have, if you're going to be self-employed, that 2-year history. You got to make sure that, you know, your debts are at a minimum, right? So those are all things that you really got to have in your pre-approval, and have that conversation with someone who's well-versed in the mortgage space, because they'll let you know, okay, that's out of the question.
Yeah.
Or this is really where you should be looking, because what you think you can do is much different than what the bank is going to say you can do. And you need your bank to facilitate your transaction, because who's paying that extra portion for your purchase, right? When you're making a purchase in real estate, your down payment is what you're bringing to the table, and the mortgage is what the bank is coming to the table to make you pull off this transaction.
Yeah.